What's up, gang? Welcome to the Wall Street Jack Boys Options Foundations course. And in this course, you guys are going to get a foundation on options in a way that the concepts will stick in your brain. They will stick after this course. All right. So to begin, I would like to cover with you guys about asset risk profiles. And this is important to understand here so that you can kind of gather why and how people are able to make money in different asset classes. So we start from safety to high risk. On the left, you guys see we have the safe zone, which is bonds. In the middle here, we have stocks. And then on the right side here, we have options. Okay, as you can clearly see, bonds says safe zone. Stocks has a caution sign, which signifies risk. Options has a sign that's similar to stocks, but it also indicates that it's high risk. So our first bulleted point says that investors park their money in bonds for safety. Although they shouldn't lose much money, the rewards are low. So in terms of safe investments, it's no high rewards when you choose safer. Okay, you don't make much, but you don't lose much. So bonds indicate that. Stocks are considered a risk asset, and there are many benefits. However, you can lose your entire investment. Now, because the risk is high, the rewards are high. So again, because you can lose everything that you put into stocks, there's a higher reward. So this is more riskier than bonds. Okay. Now, options, which is our bulletin point number 3, options are considered high risk because you can lose your entire investment plus more. You know, you get nothing tangible and they expire. So this is a time asset, meaning that you have to be able to make money within a certain period of time or it's game over. Now, this is called high risk asset returns, higher rewards. So because it's a high risk asset, it will return higher rewards. Excuse me. So I just want you guys to see here that, options is a high risk asset class. You must understand the risk before you play the game. And we just went over the risk. So let's take a look at some of the good things. So why should I learn to trade options? Well, you should learn to trade options for a couple of reasons here. These are some reasons that I have listed. So we have leverage. Leverage means that you can take like a small amount of money and you can turn it into a fortune, right? That means you can take a small amount of money and you can make a big amount of money. You can actually do that with options. Versus stocks, you need a lot of money to make a lot of money with stocks, basically. Income, you can generate large profits weekly and you can pay yourself from your gains. You can literally do that here with options. Protection. Now, if you own stocks that are losing value, you can trade options to protect your stocks like an insurance policy. Now, Warren Buffett is one of the biggest options traders out there. And in times when the market is going down, he's buying a lot of options on his stocks to protect them. So while his stocks are going down, the options are actually going up. And that is hedging, right? That's protection. So, yeah, if you have, stock investments in stocks, when the market is going down, it's a great place to stop the bleeding in your stocks. Direction. Most asset classes, you only make money if the asset increases in value. Options allow you to make money if the stock goes up, down, or sideways. Again, the key to investing is buying low, selling high. Now, options kind of flip the script on you because you can make money whether it's going up, whether it's just going sideways, or whether it's going down. So you have lots of options. That's why it's called options here. Speculation is another word for trading, right? So anytime you hear speculations in the market, it's just talking about traders, basically. We can trade with high probability of making money by predicting the direction of a stock. And that's what traders do. Traders, we're saying, hey, the stock is going to go up, it's going to go down. And if we're right or if we're wrong, we have our reward or our punishment. And then last bulletin point that I listed here was that you can buy stocks at a discounted rate with options. A lot of people don't understand that concept. But as we go through the course, it'll start to make sense here. But these are just some of the benefits that I like about options trading. And these are the reasons why I feel like you guys should trade options. All right. So what are options? All right. So options are contracts that give the owner the right to buy or sell a specific stock at a certain price for a limited amount of time. Okay. So let's just break that down just a little bit here. And you guys are going to see this more throughout the course because I really want this to stick. What are options? Options are contracts. Stop. What are options? They are contracts. All right. So contracts, they actually give the owner of the contract rights. So that contract has rights, and the rights actually allow you to buy or sell a specific stock at a certain price. So any kind of price sometime in the future for a limited amount of time, basically. So that's basically what it is. So options are contracts that give the owner the right to buy or sell a specific stock at a certain price for a limited amount of time. Now, key note here is that options are also known as derivatives. Big word. So you guys are going to hear about derivatives, fixed income, those kind of big terms. Now, derivatives basically is back to the slide that we just had here about the high risk assets, asset classes. So high risk derivatives, they consider them high risk because they're timed. Versus stocks, some stocks you can buy and hold, like Warren Buffett has been buying, he's been holding like Coca-Cola forever. And so they last a long time, but because options expire, they are derivatives, and they're high value. Derivatives actually means that it gets its value from something else. Okay. So, in particular, the options price is derived from an underlying. An underlying can be stocks, it can be indexes, it can be ETFs or futures. So the way that I can simplify this here for you is that the options itself, it doesn't have any value on its own. It only gets its value for what it represents. So in this course, we're going to be actually covering stock options. So the options get its value from the stock. To make it more simple here is that think about options as the child and stocks as the parent. Okay. For instance, my son's net worth is going to be based off of my value because he's a kid, right? And so if daddy makes more money, then my son's net worth goes up, right? If daddy lose money, then my son's net worth go down. So think about it that way. It's a derivative because it gets its value from something else. And think about the parent-child scenario, and that'll help derivatives stick in your brain. All right. Oh. Let's take it back one. All right. So remember that many options trading courses and books out there on the web, they teach options through the lens of insurance and real estate. So no wonder people give up before they start, right? You need a license to understand real estate and insurance. How I know? Because I haven't. And it's complicated. Not everybody can even pass the test. So options are complicated enough, okay? And it's crazy that people teach options with other complicated, products like real estate and insurance. So I think that I had actually found a better way. And this has actually worked for me. And I truly, honestly believe it's going to work for you guys. Or else you'd probably be going crazy like the guy in the picture here. All right. So my class here is going to be based off of coupons because coupons are options. OK, and so I actually have some coupons here. OK, I've got this nice little coupon, and then you guys can see I had a little screenshot there that's on the site so you guys can follow along with it. But just remember that, coupons, this little piece of paper here is a contract. OK, and this contract here, whoever sold it to me, in this case, would say Burger King. If I present this to them, then they are obligated. OK, they are obligated because sellers have obligations. Sellers are obligated to honor the agreement on the contract. It's in writing here. So they have to honor this coupon for me. And I'm a buyer. And because I actually bought the coupon, I have it. And because I bought it, I have rights. But I'm not obligated. I have the right to use this coupon anytime in the future before it expires. Now, what happens when coupons expire? You can kind of ball it up and throw it in the trash because they become worthless. So they no longer have any value after the expiration date. Okay, so just to reiterate here, what are options? There are contracts that give the owner the right to buy or sell a specific stock at a certain price for a limited amount of time. You are not obligated to exercise your right. So remember that. The sellers are, but as a buyer, you are not. And so let's take a look here on the screen. You guys see here the little coupon that we have. And I just want to highlight here with you, because we're going to actually make this make sense. The coupon itself is the contract. Okay. So remember, options are contracts. In this case, our contract is this coupon. Okay. This coupon gives the owner the rights. So we have rights. Okay. We have rights, which is basically going to tell us that we have the right to purchase this. It says specific stock there. In this case, we have a specific product, and this is a 10-piece nuggets and a large French fry. We have a nice little picture to go there as well that they put on here for us. So the product here, all right, and stock options will be stocks. In this case here, we have 10-piece nuggets and a large French fry. Now, why is this a value? Because the current price on this meal is $6.23. If I was to just go to the store without this contract, I'd be spending $6.23, and that's not even including the tax, right? But because I have this coupon that I purchased, they're going to allow me, it's going to give me the right, I have the right, and I'm purchasing the right when I buy the coupon so that I can buy this meal for $3, right? Why is that a value to me? Because I can save $3.23, right? Minus what I pay for the contract itself. But this is basically what options are. It is as simple as that, okay? It is just a contract, right? And they give us rights. Now, I'm going to take you guys here to an options chain so you can see options. In our example here, we have Apple. And Apple, similar to the coupon that we have, right? The 10-piece nuggets, in this case, we have Apple that represents that. And then we have the price of Apple that says $2.2924. That's the current price. And then the expiration will be down here, which says 15th of May, 2020, which we have 54 days before this expires and go worthless. And the 100 signifies that there's 100 stocks, 100 shares per contract. So each little line down here represents, an options contract. And in those contracts, one options contract equals 100 shares of stock. Okay. And so here are the strike prices. These would be like the coupon prices giving me at $3. If I want to purchase Apple at $125, $130, $135, $140, go down the list, there are different contracts that represents that. Okay. So in this case, we'll just look at 185, which is the bottom strike down here. The 185 strike, which in our coupon scenario would be like the $3. So I can buy 100 shares of Apple for $185 before the contract expires, which is May 15, 2020, which is a good deal. But we don't know the price of Apple in the future, but we know right now Apple is, higher than that. So we definitely would like to take advantage of Apple at that rate. So that's how you get the good discount rate if it works out. Okay. So the key to options trading here is that we want to distribute the contracts. As you can see, stock options is a great product that allows investors to buy stocks at a discount. However, most options traders do not desire to exercise their rights to take ownership of the stocks. We do not want to own the stocks. We have no intent of actually buying the stocks. Instead, we prefer to wholesale the options contract to someone else for a profit. This wholesaling of rights is what makes up the options market. To be clear, we are not buying stocks. We are distributing the rights to buy and sell stocks for profits. If you don't have a contract, then you don't have rights. Therefore, we're looking to get our hands on those contracts and to sell them for a profit without ever taking ownership of the stock. Remember, if you don't have a contract, you don't have the rights. So the key is to get our hands on these contracts here so that we can get those rights, and we're going to sell rights. It's going to make sense here for you guys in a few moments, but just remember that we're actually wholesaling the stocks, all right, through options. So therefore, we're just never touching the stocks. We don't want them. We just want to sell these here for profits. All right. So if you guys took the Stocks Foundations course, then you already know the scenario about stocks and the stock market as an auction. Well, guess what? There's an auction for options also. So remember, we just left off at, to get our hands on those contracts, we must go to the options chain on a stock that has options and join the auction as a buyer or seller. Okay. So remember that, we have the options chain, which I'm going to show you guys here in a few. But if we want to get our hands on the contracts, we have to go to that place where the auction is going down. It's going down on the options chain. All right. So if you want to get your hands on here, you got to be there. And when you get there, there's going to be bidders. There's going to be the bid and there's going to be ask, basically. So if you want to buy, there's going to be people that have them and they want to sell them. So in this case here, in our coupon scenario, let's just say that the bidders, they would like to buy this contract here, this coupon, for 95 cents. However, the seller here, they want to sell it for $1.05. The brokerage is going to actually put in the order, and we'll meet in the middle for $1. We'll set our limit order, and then we'll go up to $1, basically, because the seller said, hey, I'll take $1. And then we actually make the transaction. It's complete at $1. So I'm going to buy this coupon here for $1. Now, I'm buying it for $1 because it has good value, right? Why does it have value? Because let's say, for instance, I actually do want to use my rights. I want to exercise my rights to go and purchase the stocks. In this case, I want to purchase the 10 nuggets, okay? If I want to do that, remember, I get to purchase something that's worth $6.23 for $3. And I'm spending $1 on it, so that's $4. That means I'm still walking away with a $2.23, advantage. So would I spend $1 on it? Yes, it makes sense, right? Because I'm still going to get the deal, and somebody's selling it. I don't have it. They have it, and I want it. I'm going to actually, take advantage of that. So I'm going to buy it for $1, okay? And how do I make money off of this? I am going to sell this whole coupon for $2 to somebody else, okay? And I'm going to make, $1 profit here. That's how we're going to make money. We don't want to tie up our accounts with stocks. It's not an efficient way of using your money to trade, right? This is the most efficient way to do so. I'm going to explain here to you in a second, but I just want you to understand, in this scenario, we're going to buy the coupon itself and hopes to sell it to somebody else for $1.50 or $2 or $3, right? So the more we can sell it for, the more money we can make. Okay. All right. So we're going to talk a little bit of math here, but don't worry. You don't have to know any kind of math. The trading platform is actually going to take care of the math for you. But I want to show you how the numbers are derived. It's nothing complicated, not at all. I got the screen split up in two ways here. On the left side, I do have the scenario for the coupons. And then on the right side, I do have a real option scenario, which is on the stock Apple. Key thing to remember is that one options contract equals 100 shares of stock. So every contract you have to multiply by 100 shares. So the math here would be the quantity. So how many are you actually buying or selling? The trade price, which is the price that is going for. In our scenario here with the nuggets, we were able to get that for $1. And then we multiply that by 100. And that will give us our premium. So in the options world, we talk in terms of premium. This is a term you have to be familiar with. What is the premium? The premium is the price that we pay for the options contract, or, what we collect from being a seller, because you can enter as a as a buyer or seller. But just so you can grasp the concepts, we're not going to go there yet. I just want you to really get the concepts of what's happening, what is taking place, so you can conceptualize this before we get into some of the nerd stuff, right? So anyhow, if you take a look here, we have one contract, one coupon, right? So it's that 1 times $1, because we actually got the price. We actually got we won our bid here at $1, and then we multiply by 100 shares. Okay. And that's going to be $100. So when I say don't let the small numbers fool you, because on the options chain, you'll see small numbers that says $1, but you have to remember you always got to multiply it by 100. So we're not actually, trying to make $1. We're trying to make $100 or $1,000 or 10,000, right? Options allow us to do so. So the premiums that we're talking about actually is the number you see times 100, basically. So just think about it this way with the coupon scenario here. This coupon gives us the right to purchase 10 nuggets, right? But let's just say, compared to stocks, we add a 0 here, and that's going to give us the right to control 100 nuggets, okay? So to kind of think about it that way, because it's going to kind of make a little more sense here when I switch over here to the stock side, right? So, not even that. Actually, what would make sense would be if we had 100 coupons, So leave the 10 nuggets alone. But what if we had, 100 of these coupons? Here we go. So the dollars start to add up, right? Because they're $1 a piece, right? So we have to multiply that by 100 of these, right? So let's just say each coupon is going to represent like a share. There we go. Because every options contract equals 100 shares of stock. So on the right side, when we take a look here, Apple, volatility is pretty high right now. And so these contracts are really expensive as of right now. But we take a look here at the 185 strike, which is at the bottom. Okay. You want to buy the Apple for $185 before May 15. The mark price is somewhere in the middle between the bid and the ask. So we just took $54.97. That's where the price comes from. $54.97. One contract times 100 is not $54.97. It's $5,497. So if you actually want to buy this, you're going to need $5,497 in your account to participate in this particular strike on this particular stock. So again, I just wanted to use this slide to show you guys to not let the small numbers fool you because you think we're playing for dollars and we're not. Okay. You must multiply those by 100. All right. So stocks versus options. All right. A lot of people come to the game. They want to know stocks. And again, you have different types of stocks like momentum stocks, your penny stocks. But the blue chip stocks are expensive, right? And so most people don't have enough money to purchase the blue chip stocks like Apple, right? And these stocks, they are expensive. And if you really want to be a stock investor or a stock trader, you really need to buy bulk, right? So if you buy one share of Apple and it moves $5, I mean, you only made $5. It's nothing to brag about, right? But if you have like 1,000 shares, then you multiply, how many you have times 5, that's big money. So that makes sense that you need to buy in bulk. However, most people don't have that kind of money. And so in this scenario, if you wanted to actually buy the stocks in Apple at $2.2924 at the time of this example, you must multiply it by 100 shares if we're talking about an equivalence to options. And that will come out to $22,924. That means if you want to buy 100 shares of Apple, okay, you need to have at least $22,924 in your account, okay? And that's so that you can take ownership of those stocks. However, in the options world, you can take control over 100 shares of Apple, okay? And what we do, $54.97 times 100 shares is only $5,497. And so you can actually participate in this expensive stock with much, much less money, $5,000 versus $22,000. Okay. So trading and investing with options is a much more efficient use of capital in comparison to stocks. And when you buy stocks, the money is tied up in hopes to return value over a long period of time. Right. So most stock, investors, they hold in for 10, 20 years down the road. With options and with trading, these things are limited. As you guys see, we got 54 days here to make our money, right? And so you can generate exponential returns in days, weeks, and months with options. We're going to make the same amount of money as a stock trader does, or even greater than the stock trader does, using a smaller amount of money